Hello and welcome to CIMA Australia Exam Preparation Series. My name is Cliff Bowles. I'll be your presenter for this series of films. In this film we're going to deal with operational case study for February 2015, and this is exam preparation 1 of 2 films for this case study. If you'd watched the earlier exam preparation film, you'll see that I advised a process for dealing or tackling a case study, and I'm going to use the same process for this operational case study. In the previous film I suggested that you download the case study as soon as it becomes available and make 3 copies, and to read through the case study at least 3 times before you start to do any analysis, and leave a couple of days in between each reading to let the scenario be absorbed into you. And then I suggested that you go through copy 1 of the case study, print out with a marker pen, and highlight anything that rings a bell with you or stands out as significant. Don't be too analytical at this stage. What you're trying to do is get a feel for the case study. I then suggested you wait a couple of days, and then with a different colored marker pen, mark up copy 2 with things that seem significant to you, but without consulting copy 1. Just look at it again afresh. And after you've done the second marking up of the case study, go back to your CIMA website or wherever you get your CIMA information from, and let's have a look at what this integrated case study exam is really going to ask you to do. Well, we know that it's going to be 3 hours long. We know there's going to be some pre-seen material, but there's also going to be a database of related information, and there's going to be some unseen material which will be made available during the exam. The case studies will have their own calculations or short answers and essays, and in this case for operational it's going to focus on application. They're also going to be a focus on the CIMA hierarchy of verbs, and again I suggested that you go back if you haven't recently and look at these hierarchy of verbs and once again familiarize yourself with what they mean. For example, level 5 verb advise means to counsel or to inform or notify. These case studies are integrated, which means they're integrating the pillars of each level, and what they're trying to do is allow you the opportunity to demonstrate your familiarity with the context and the interrelationship of that level's subjects. And so this is reflecting a cross-functional working which is required in the workplace today. Some of the skills will include research and analysis, and I'll talk about those shortly. Some of the skills will involve presentation of both financial and non-financial information and some communication skills. So let's look a bit more closely at the operational syllabus. The operational level covers the implementation of strategy as well as the reporting on the implementation of strategy, and the focus is short term. So we know that we're not going to be looking at long-term strategic planning here. We're going to be dealing with short-term implementation of things. And if we want to know what sort of things are going to be implemented, we need to look at each of the pillars of level 1. For example, E1, we can see that the topic weightings are dominated by organization. There are many other things: managing the finance function, human resources, managing IT. And when we get to management accounting, P1, we can see that costing, budgeting, and short-term decision making are going to be foremost. And in F1 we can see financial accounting and reporting is a significant portion of those topic weightings. In the first exam preparation film, I suggested something you might do would be to take the weighting of each of these elements of the level and to sort them by weighting percentage, so you can get a sense of which are the important topics that you need to be aware of when you're looking at this case study. In the case of the operational level, financial accounting and reporting, cost accounting, decision making, organizations, budgeting, etc., they're going to be, if you like, the most probable, certainly not the only ones, but the most probable ones that you'll come across in the case study. You may get something on the regulatory environment down here, but the probability is that you're going to get something in this area. So what we do now, we've marked up copies 1 and 2 of the case study, and now what we want to do is have another go with copy 3, and armed with the knowledge of topics that are important, we might be able to go through now and look at the case study and look in particular about implementation. Look at things that are going to be needed in the short term, and look at those things that might relate to these items in the top half of the syllabus weighting. And then maybe we'll start asking some questions. So before we can formulate the questions, we need to do one more thing, is to understand our role, our audience, and the case study focus. And there's a different role and a different audience and a different focus for each of the levels. In the operational level, your role is the level of finance officer. Your audience, the people you're going to be reporting to or undertaking tasks for, are managers and product owners. The question types that are going to appear in the exam will be short essays, supported by calculations and analysis. So when we look at the individual elements of the level, for example E1, the case study focus is going to be the analysis of the structure of the organization as well as cross-functional communication. In P1, case study focus is going to be on a costing or a budgeting issue, and in F1, preparation of parts or entire financial statements. So now we're going to have a look at the case study again for the third pass. We're going to mark up some things, but this time we're going to also specifically ask the question, are there any organizational issues? Are there any cross-functional communication issues? Is there an obvious budgeting or costing issue? Which calculations might be required? And which elements of the financial statements might need to be prepared? Let's have a look now at the case study and mark up as if we were doing it for the third time. So in part 1 of this case study, what I'm going to do now is I'm just going to go through the case study slowly, and I'm going to mark up things that stand out for me as being something that needs further investigation. I may be going to ask myself lots of questions. I'm going to just highlight something and say, I don't understand this. And what we might do in film 2 is take some of those questions and follow them through and try and understand in more detail what the issues are and what the likely questions might be in an exam. In this stage, what we're doing is we're just going through and highlighting and asking questions and really just having an identification of something that might be an issue. So for example, it doesn't seem very relevant, but country A is in Northern Europe. Country A is not at present, and it's those words at present, part of the Eurozone. And when we look at the marketing material later on, it seems obvious that the Eurozone is a big potential market. Is this something that might be relevant later on? Yeah, there might be some barriers to entry, for example. So I'm just highlighting that as something that might be worth considering. Valley Spring has 3 customers, 2 supermarket chains and a major wholesaler who distributes Valley Spring's products to small retailers. All 3 have several depots at various locations in country A. So we've got a domestic customers here, and the 2 words that I thought of when I read this small paragraph was customer profitability. Do we actually know which of these chains or wholesalers is profitable? Which is one better than the other? Is there some distribution channel that is better than the other? We can't tell from the information that we've got so far. We've got a manufacturing process. Obviously, if you've got a management accountant somewhere around, then manufacturing process is going to be of interest. Of interest to me when I was reading this was that there's been no expansion for the last 8 years. The original plant was expanded 8 years ago with the assistance of government grants, and there's been no major expansion since then. So what does this tell us? Well, it tells us that either there's plenty of capacity and there's no need to expand, or there's no market to expand. So when we look at the marketing information later on, it looks like there's a huge opportunity to expand. So it's a question, and it's a question we'll come back to in film 2. We've also got a bottling process, and when we look at the costing reports, we've got a process, and we've got water, and we've got batches, and we've got a costing system. And a question might arise, is this the right sort of costing system? We need to maybe come back to that in film 2. The words efficiency and quality control ought to be of interest to a management accountant. We've got a distribution network, so when we're looking at the organization, there's a manufacturing process, but also we've got a distribution department. So here we have an element of an organization, and there are 15 large articulated vehicles and 20 drivers. I don't know whether it's relevant that there's a difference in the number of drivers than the vehicles. The department is responsible for delivering to the 3 depots. The fleet operates for most of the year. So is it a mountainous region? Does it get snowed in? Is there a seasonal pattern here that we need to be aware of? Occasionally, and the word occasionally is used twice, the fleet is used to undertake haulage contracts for other organizations if suitable loads can be found. So is that an opportunity or is that a diversion? We don't know. Marketing and product development. So here we have another embryonic department or an embryonic department. Marketing and product development department is the most recent addition to the organization. So we've got now a product development manager, John Bond, and his job is to investigate further development possibilities. So the 2 words that came to mind when I read that were target costing and also expansion. So maybe that's something we need to consider. Business is owned by the Taylor family, the sole shareholders. So there are no external shareholders to consider at this stage. The founder, Samuel Taylor, he wants to retire from the business over the next few years, so there's going to be a change in ownership and perhaps a change in direction. His son is the production director. He's also responsible for quality control and distribution. He's already taken over some of his father's duties and has many ideas for the future of the business. So immediately when you see that, you see somebody who's got a lot of responsibilities and who's probably spread very thinly. And maybe from an organizational point of view, we might want to come back and look at that. Claire Taylor, Samuel's daughter, is the finance director and responsible for the finance and administration functions. Highlighted very clearly, she has no formal finance qualification. Now that is a real concern, and that's something we need to come back to and understand the consequences of that. The business currently employs 190 staff divided into 4 departments. So we've got production, we've got distribution, we've got finance, and we've got marketing and product development. So here we have an embryonic organization. If we look at the numbers, we've got 155 in production, we've got 22 in distribution, we've got 10 in finance, and 2 in the marketing and development. So there's obviously a disparity here in the structure, or an unbalanced structure. So that's something we might want to come back to. Claire Taylor is responsible for finance and administration. You, the management accountant that's taking this exam, has been recently recruited as a finance trainee. So your role Instead of being a finance officer, you're now a finance trainee, assisting in the day-to-day routines of the department, production of monthly management reports, year-end financial reports, and other reports as required. So here is the scope of your work. You're not going to be asked to do anything outside of that scope. Of a concern is the next sentence. The manager of the finance team has recently left the business, and Claire has assumed these responsibilities until a suitable replacement can be found. So now let's have a look at the statement of profit and loss for the year ending 31st of December 2014 with a comparison for 2013. What we might do in Film 2 is do a horizontal and vertical analysis, but a quick calculation of the comparison, for example, of gross profit and profit for the year shows there's been a slight increase in gross profit, a slight reduction of profit, and a slight increase in distribution costs. But on the face of it, there doesn't seem to be anything serious here that warrants a great deal of investigation. But we'll look further at this in Film 2. So now we'll look at the statement of financial position. And again, we've got 2014, 2013 comparison. On the face of it, the balance sheet looks fine. It looks strong. There doesn't seem to be any particular issues. Debtors and creditors seem within reason. I'm going to come back to you in a moment and talk about property, plant and equipment, because we can see here that property, plant and equipment has gone down. We need to understand what's happening there, and we can do that by looking at the statement of cash flows. It will give us a clue as to what's happening there. Statement of changes in equity, nothing outstanding here. That we've got a profit for the year and a large amount of dividends paid. There's been some loan paydowns, but as far as the shareholders are concerned, it's a family business, a large dividend, it's their money. So I can't see any particular issues there at this point in time. When we look at the statement of cash flows, we can see how much depreciation has been charged for the year, 670. And if we go back to the statement of financial position, we'll see that the opening property, plant and equipment, 16.1 million, and the difference between the opening and the closing is 15.43, is exactly 670,000. So the opening balance minus the depreciation equals the closing balance. So what that tells me, there's been no capital expenditure in 2014. Is that significant? We don't know, but that seems to imply that. The cash flow for almost everything else looks okay to me. Now, to me, this is the page that is going to be the focus of any questions, I think. What we've got here is a budget for the year ending 31st of December 2015. And we've got to work our way through to try and understand how this works. We've got budgeted sales, 40.99 million. That's just a little bit higher than the current sales, which is 40.560. Not a great deal higher. The gross profit, if we scroll down a little bit, we scroll down, 18.52. That's compared with 18.25. So again, a little profit. And if we look just cursory glance at the contribution per product, so we've got here contribution per product, and if we work those out very quickly, we can see that contribution for still 250 millimeters is about 67%. The 750 mil is about 73% of sales. Sparkling 66%, 72%. So they look consistent. And if we look at the gross profit, which is after charging production overheads here, we can see that gross profit for product still 250 is 44%, 44%, 46, 46. So there doesn't appear on the face of it to be anything in particular that is a problem in terms of calculation. Although when we get to film 2, I'm going to develop an Excel sheet to reproduce this. This will do two things. It will prove to me that the numbers are calculated correctly, and it will also force me to understand how this calculation or this series of calculations are actually done. So we can see here we've got some notes here down the bottom. Inventory levels, production and sales are equal, so there's no variation in opening and closing inventory. We need to consider if there's any inventory in the balance sheet, and when you look at the balance sheet, there's 2.6 million in the balance sheet. Now again, is that an issue? We don't know. There might just be a timing lag. Direct production hours are initially measured at 1,000 liters of water and then converted into a cost per batch of 1,000 bottles of product. And in the next page there's some workings which we'll look at in a moment. All costs other than plastic bottles, labels, gas and direct production labor are treated as fixed costs and are absorbed into production on the basis of direct labor production hours. Well, to me that's the red rag here. We need to look at that very carefully, because that to me is something that looks very suspicious, or not suspicious, but the wrong way of doing something. So we might have a look at that in film 2 a little in more detail. We've got some calculations here of how many direct labor hours per 1,000 liters of water. That's converted into batches. The number of hours per batch is calculated, a rate per hour is used, and a direct labor cost per batch is calculated, just here. So then we can calculate the direct production labor hours. We've got the number of batches from the previous page. We've got the number of hours per batch, and we can work out that there's 255,000 direct labor hours. At $10 an hour, we can say that the labor cost, the direct labor cost, is 2.5 million. And again, we'll come back to that in film 2. The calculations on the face of it, they look okay, but it might be a good idea if we were to reproduce these calculations in Excel or something, just to make sure we understood them. The next page deals with budgeted annual production overheads, and this to me is an area of great concern. So we've got $10.6 million worth of production overheads, and we've got 255,000 direct labor hours. So using traditional overhead absorption costing, we're going to charge each labor hour, each direct labor hour, $41.64 to take up these overheads. Well, let's have a look at these overheads. 6.8 million for energy. If we're paying $10 an hour for labor, the direct labor hours are 2.5 million. So we've got one of these costs which is 3 times more than the direct labor. Never mind these other things, these other production costs. So my question would be, my big question is, why are we using overhead absorption rate, direct labor hours? Is there some other rate we should use, or is there some other form of allocation of these overheads that we might consider? And maybe we can look at activity-based costing if we had the right sort of information about these activities. So that's a question for film 2, but it's a big question for me at the moment. Now, so far we've seen very little to do with financial accounting and reporting. And when we look at this information about the tax regime in country A, we can see that the tax rate applicable to taxable profits is 30%, and yet if we look at the statement of comprehensive income, the tax charge is about 22%. So I've got a question there. Is there something that we need to know, or is there something going to be talked about? Unless otherwise stated, accounting rules on recognition and measurement are followed for tax purposes. These things are not allowed for tax purposes, pretty much like in Australia, accounting depreciation. We need to use tax depreciation, amortization, entertaining expenditure, and so on. This is of interest to me. The tax depreciation allowances are available on items of plant and machinery, including the vehicles used for business purposes, at a rate of 25% a year on a reducing balance basis. 25% a year would indicate that there should be a substantial write-down. And what puzzles me is that the amount of assets are 15 or 16 million. The depreciation is 600 and something thousand, so probably 10%. We've had no capital expenditure last year, and we've had no expansion for the last 8 years. So is there some problem here? Have we missed the opportunity of depreciating and getting a tax deduction on these assets? So again, big question mark, and it may be something that will arise. So now what we've got are several pages of marketing material, or material about the world markets and the markets for bottled water in country A and in different countries. Now we've got to look at this material with a bit of a skeptical eye, because a trainee accountant is not going to get involved, I don't think, in looking at strategic plans and marketing. They're going to get involved in calculations and implementing. So what we might want to do is just look at the things that might give rise to some change in direction or change in strategy that may be required to be implemented by you, the trainee accountant. So what I've just done is I've highlighted a couple of things in each of these pages. Valley Spring now accounts for 10% of the market in country A. In its most recent financial statements, posted revenue over 40 million, equivalent to sales of almost 19 million litres of water. Now we need to just check that number. Is that consistent with what we've seen? The amount of $40 million rings a bell, because we've been given that in the profit and loss account, and 40.56 is the amount. But 19 million litres of water, does this stack up with our costing budget that we just looked at? Down here we've got this thing offering many logistic opportunities. So we've got some opportunities here. We've got these fleet of trucks. They might sometimes get loaded up on the way back, and they might not. Is there an opportunity here to really make some use of those empty trucks on a consistent basis? So that might be something that a trainee accountant might get involved in doing some calculations about. The next page is an industry report for 2014 and beyond by the Chief Executive of the Association of Bottled Water Producers in Country A. The only two things in this short report that I can suggest might be interesting is that the imports of bottled water by volume have fallen, perhaps demonstrating the strength of the local industry. And he's talking about exciting innovations arising in the industry. So again, something perhaps that there's going to be introduced a new product or a new something, and that might tie up with things that we read later in the marketing material. The next set of graphs is talking about consumption, global consumption statistics. Although you can't tell what the consumption is, all you can see that where the major markets are, but there's no indication of how many millions of litres were sold. It might be a 10 million or it might be 100 million. What we can see is that country A is 7th in terms of consumption per capita. So country A is a big consumer per capita, per number of people in the population, but 34th in global consumption. Relevant? I'm not sure. Then we've got a lot of material about the analysis of the global market. We've got an overall increase over 10 years, although that's difficult to know whether it's good or bad unless you can compare it with something else. Sports beverages are still small by comparison with the top 3 beverages, 10% of the bottle market. We can see European countries prefer mineral and spring water, which is what Valley produces, and we can see that still water outstrips sparkling water consumption, approximately 4 times as much still water as consumed than sparkling. Although if you look at Valley Spring, you'll see that production is not 4 to 1, it's actually 50-50. So there's some production number here that goes against what the market is telling them. Some interesting information here, but how relevant is it to the person who's going to be a trainee accountant? I'm not so sure. Sometimes these case studies can have a lot of material, a lot of data, which is really a distractor rather than getting to the point. But we can see here the production of bottled water in country A is growing at a faster rate than consumption. So that doesn't bode too well. But there's obviously some excellent quality in terms of mineral content in country A's water. Is any of this useful? We'll come back to this when we do film 2. So now let's have a look at the breakdown of consumption by type of bottled water. Mineral and spring water, 84%. Well, mineral and spring water is exactly what Valley produce, so that's consistent and that's fine. We've got again this statistic that is going to be probably important. Still water accounts for 70% of the bottled water consumption against 30% for sparkling water. 5 years ago it was 60-40, now it's 70-30, so there's obviously a trend here. And again, I'll draw your attention to the fact that Valley is making about roughly 50-50 of still water to sparkling water. So maybe there's an argument to reduce the sparkling water and increase the still water. And however, there are a couple of new trends emerging: flavored waters and isotonic enhanced water. So we're going to see the next section about that. So the future for country A's bottled water producers appears to be promising. Global demand appears to be expanding. There's going to be a significant increase in the demand for natural mineral and spring waters because of their health benefits. Country A already has a good reputation, and country A's producers are well placed to take advantage of this global trend. So now let's stick with those words, the global trend, for a minute. Global trend would imply either having distribution channels, because the water has to come from country A. You can't reproduce this water in China or in Hong Kong or somewhere low cost. The whole purpose of country A's reputation is that the water comes from the mountains, a bit like the French Evian water, I guess. So if we're going to take advantage of this global trend, what we're talking about here is to set up a new distribution network outside of the geographic location of country A. And what we need to do is to think about how this might be done given the organization structure at the moment. We have a big production structure. We have a very limited management team who probably have no experience of setting this up. So this is an organizational issue that we need to come back to when we look in film 2, how we can develop these issues. We've also got to look, there is a new product in the market called isotonic enhanced mineral water, and many producers are now starting to experiment with this, and this could be a huge potential as consumers become ever more sports conscious. So what we've got here is the possibility of a new market globally, and we've got the possibility of a new product. Now, if we have a new product, what we're going to need maybe some new equipment, maybe some new skills, maybe some new something. So this, I think, will have an impact not only on the business, but also on the management and organization of the business. So we've gone through now and we've identified some issues. What now should we do to develop those issues and try and understand a little bit more about them. Well, let's take one of those issues first. So let's have a look at this costing report. There are several things here that might affect this budget, and let's see what sort of things somebody might come along. The production manager, he might come along and say, well, I want to now change the production mix, and instead of making 50-50 between still and sparkling, I now want to make 75-25, for example. 75 still, 25 sparkling. How would that affect the budget? So that might be sort of question that might get asked, and in film 2 we'll look at that question and say, how might we answer that if such a question were asked? And one of the preparation tasks for these case studies is to simulate a question and say, well, if I had to answer that, how would I go about it? Okay, you won't have much time in the exam to decide then, so it's much easier if you do it beforehand and find out the pitfalls or the quick ways of doing something. So that's the first one that might happen. The second one that might happen is that somebody may suggest that this method of allocating overheads using the absorption method, direct labor cost absorption method, is inappropriate when in fact the overheads are really only partially related to direct labor. If we looked at the 10.6 million, only 1/4 of that would be equivalent to the amount we're spending on direct labor. So on what basis are we using this direct labor absorption rate? I think it's unsustainable. So one of the things that may happen is that somebody could come along and give us some information about these particular overhead activities: energy, depreciation, quality control. And let's say we were given a series of information about each of these. The next thing to do would be to say, well, let's recast this budget. Let's redo this budget. Let's redo this absorption cost, not on the basis of direct labor hours, but on the basis of activity-based costing. And if that were the case, what sort of contributions or gross profits might we get on that basis? And does this make any difference to our decision to increase or decrease the carbonated water? For example, if in this energy cost, a good proportion of that energy cost was related to carbonating the water, for example, and if we were to reduce the manufacture of sparkling and increase the still products, and would that significantly reduce our energy costs and improve our profits as well as sustaining the market? So that would be perhaps another question that I would ask. The third question I would consider doing some calculations about was depreciation. And what happens if the method of depreciation is going to change? How would that affect the budget? How would that affect if we had to use 25% reducing balance? Would the depreciation charge, which in the budget is exactly the same as the amount in the financial accounts for 31st December 2014, so if we changed the depreciation rate or method, you may get asked, for example, to explain if that would affect the December 2014 financial accounts. Would they need to be restated? And you might have to support that with accounting policies or generally accepted accounting principles or a standard. I'm not going to explain it to you. You need to do some research on that. But that could be a question. There could be a question about tax. the amount of tax that they're paying doesn't really stack up. So there's something, and we'll look at this a bit more in film 2. There's something that we need to perhaps research. The thing that I'm concerned about as well, and this relates to the organization. So in E1, organization, structure of the organization, and cross-functional communication, is this situation here where we have a person who's founded the business, who wants to move away from the business and pass it over to his children. We've got one child, the son, who's got wide responsibilities: production, quality control, distribution. He's taken over some of his father's duties, so presumably some managerial duties, and has got many ideas for the future of the business. So he seems like he's got a lot of power and a lot of responsibility. So maybe some of the issues there might be bringing in other people, delegating, and so on. But here we've got another problem where the daughter, who's presumably an equal shareholder, she's responsible for a function that has to produce information that is used by the tax office and various other things, but she's got no formal finance qualification. There's nothing to stop legally somebody doing that, but it's a danger, because danger from not knowing what's happening. For example, if that method of absorption is being used and she's not really been trained properly, she might not see that it is a problem. And there could be some contention if the son, Mark, wants to do something and wants to direct you as a trainee to do something or change something or calculate something, and she doesn't want you to. So I see an issue here that perhaps we need to explore a little bit more. I see the problem organizationally, that having one department of 155 and a department of 20 and a department of 10 and a department of 3, there's a structural problem as well. And we may need to think about that, particularly if they're looking at expanding the product line or changing the product line, using the distribution network more effectively, or enlarging the distribution network to go to other countries. So that's what I would call the third pass of going through a case study. And it doesn't mean that I'm happy with what I've found. I've just flagged for myself that these are some of the issues that I need to explore more. And the way that we might explore them will be the subject of film 2, where I'll take some of these issues and I'll try and relate them to some of the syllabus that E1, P1 and F1 have, and see, well, look, this is something that you've been asked to concentrate on. For example, in P1, the comparison of activity-based costing and absorption-based costing. It seems ideally suited. But in terms of the F1 and E1, we need to look more closely at their syllabuses and identify which part of the syllabus resonates with the issues that we've found in this case study. So don't leap forward straight away to film 2. Have a think for yourself now. Do a bit of research yourself. What sort of things might there be in syllabus for E1 or P1 or F1 that maybe connect with some of the issues that we've talked about? Find an issue, find something in the syllabus that connects to it, and then extrapolate what could happen. For example, I've talked a lot about activity-based costing, but one of the questions might be, we want you to introduce activity-based costing based on these activities, and here's some information. Will you recast this budget and give us an idea of the profitability of each of these products? That might be something that we'll do in film 2 by building an Excel model, and this will help us to understand and help us to think about it and plan for when the exam comes. So until Form 2, I'll talk to you then. Bye for now.